Let's talk about PPE. Let's talk about investment property and the differences in their revaluation rules. My name is Tom Clendon, and I am here to help you pass SBR. I am here to help you understand the basics of financial reporting. So let's take first of all ISA 16, property, plant and equipment. Now, this is the standard which regulates how we account for our tangible assets, those that have been bought for use within the business and have an expected life of more than a year. Examples include office buildings, computers, machinery. Now, the standard requires that such assets must be depreciated, must be systematically written off over the accounting periods expected to benefit from their use. This is an application of the matching concept. An exception is land. Now, the reason that land is an exception is because land is deemed to have an infinite life, so it can't be systematically written off over its useful life. Now, there's a measurement policy, there's an accounting policy that management can take in respect of its PPE. And it gives us the choice as to whether such assets are revalued or accounted for effectively at an historical cost basis. Now, if the accounting policy of revaluation is adopted, then the valuations are to fair value. So we could talk about IFRS 13 there, but I won't get distracted. And those valuations must be kept up to date. And all similar assets must be revalued. So if you're revaluing one factory, you'd have to revalue all of your factories. It wouldn't mean that you would have to revalue your, your machinery or your motor vehicles. But if you revalue one asset, all assets in the same class must also be revalued. And depreciation must be continued to be charged on the revalued amount. In other words, you're going to be increasing the expense that goes through the P&L. So you're going to be reducing your reported profits. That's a consequence of revaluing PPE. Now, in very simple terms, the revaluation gains and losses that arise don't go through the P&L. In very simple terms, the revaluation gains and losses are recognised in equity, and therefore they are reported in other comprehensive income. However, that's a little bit simplistic, and it is possible that revaluation gains and losses are recognised through the statement of profit or loss. So let me explain the revaluation rules as per ISA 16. Gains go to equity unless they are a reversal of a loss that has been previously charged to the statement of profit and loss. Losses go to equity until the reserve relating to that asset is exhausted, and then further losses are charged to the statement of profit or loss. Let me say that again. Gains go to equity unless they are a reversal of a loss that has previously been charged to the P&L. Losses go to equity until the reserve relating to that asset is exhausted, and then further losses are charged to P&L. But let's do an example, and it's going to be a fairly simple example so you can keep it in your head. Let's consider that we bought some land for 100, and then it's revalued to 150, and then later it's revalued to 90, and then later to 125. Let's consider how each revaluation gain or loss would be accounted for. Well, in the first case, the asset cost 100 and is being revalued to 150. So in the first year, the revaluation gain is 50. Straightforward, all of that gain is recognised in equity and reported in other comprehensive income. But in the second year, the value of the asset has fallen to 90. Now remember, you've previously revalued it to 150, And therefore, if its valuation is being kept up to date and it's now 90, there is a loss of 60. Now, my first reaction is to take that loss of 60 directly to equity through other comprehensive income. But once you've exhausted the reserve, and the reserve is 50, once you've exhausted that reserve, then the further loss of 10 is charged to the P&L. So we've now got an asset which has been revalued to 90, and we've charged 10 in the P&L. But in the third year, the asset is now revalued to 125. So if the asset is revalued to 125, but it was previously carried at 90, there is a gain of 35. Now, normally you take the gain directly to equity, but we've got here an example of the reversal of a loss which has previously been charged to the P&L. The first 10 of the gain is taken to the P&L because it reverses a previous loss, and then the remaining 25 is taken to equity. I hope you're still with me. You have the benefit, of course, of being able to listen to this again, maybe write it down. Now, by contrast, investment property are not sort of operating assets. They haven't been acquired for use within the business. They've been acquired for their investment potential, whether that be rental income or capital appreciation. And like PPE, there is an accounting policy choice as to whether you measure your investment property either at cost or fair value. If you measure them at cost, the same principles apply as PPE. In other words, the depreciation element, the building will be charged. That will be systematically written off through the P&L over its useful life. If the fair value model is adopted for investment property, I quite like that. I think that's more relevant. I think that's more forward-looking. I think that is predictive of the future cash flow when you come to sell the asset. So I quite like, conceptually, I think it's more useful to have investment property at fair value. I think you're holding management to account, because if you have it at fair value, then the gains and losses on that investment property go through the P&L. So there's accountability and the stewardship, and there's no depreciation being charged. And that gain would go through, according to IFRS 18, that would go through as an investing line in the P&L. Yeah. Whereas if you've got an investment property at cost, the depreciation would also go through the investing line in the P&L. So isn't SBR integrated? You know, I started off trying to talk to you about ISA 16 and ISA 40, but I've mentioned fair value, I've mentioned the framework, useful information, and I've even mentioned IFRS 18, presentation and disclosure within financial statements. Thank you for listening. My name is Tom Clendon. I help ACCA students pass their SBR exam. If you need support, reach out to me. Yeah, please like, please subscribe wherever you get your podcast from. Thank you very much.